Namaste! Wish you all a happy new year 2025 and welcome to my FinHub. Did you know that in 2024, India hit a record-breaking milestone with 268 IPOs, raising over rupees 1.67 lakh crore? This incredible feat puts India ahead of several major economies like China and the USA in terms of IPO activity. Excited to know more? Stay tuned as we decode everything about IPOs, OFS, and FPOs with real examples from Indian markets to make it easy and relatable for you. First things first, what is an IPO? An initial public offering is when a company sells its shares to the public for the first time, transforming from a privately held entity to a publicly listed one. In simpler terms, the company raises funds by giving people the opportunity to own a slice of its business. For example, the IPO of SBI Cards in 2020 was one of the most talked about public offerings in recent years. It allowed everyday investors to own a part of the credit card business of India's largest bank, SBI. There's another term, OFS. How is it different from IPO? An OFS, or offer for sale, happens when existing shareholders, usually promoters or big investors, sell their shares to the public. Unlike an IPO, the company does not raise fresh funds. Instead, the money goes directly to the sellers. When Hyundai launched its OFS in 2024, the Korean promoter sold its stake to reduce its holdings. In simple terms, an IPO brings new money into the company, but an OFS is more like reshuffling ownership among shareholders. No new capital is raised for the company. Wait, but what about an FPO? And follow-on public offer occurs when a publicly listed company issues additional shares to raise more money for expansion, debt repayment, or other purposes. For example, Yes Bank's FPO in 2020 was aimed at strengthening its capital base after it faced financial difficulties. Think of an IPO as opening a restaurant and an FPO as expanding it by adding a new floor. The concept is the same, offering ownership for cash, but it happens after the company is already publicly listed. There are very complicated and expensive processes involved in holding IPOs, so let's check. Why do companies hold an IPO? Companies use IPOs to raise money for growth, new projects, and expansion, build their brand and credibility, allow early investors like venture capitalists and promoters to exit partially or completely. Nika, a well-known online beauty platform, raised funds via its IPO in 2021 and used them to grow its operations and strengthen its digital presence. Do you know where does the money from an IPO go? The destination of the funds depends on whether it's a fresh issue or OFS. Money goes to the company for expansion, debt repayment, or operational growth when it's a fresh issue or FPO. On the other hand, money goes to existing shareholders selling their stakes in case of OFS. Nothing for the company, sadly. Who benefits from an IPO? The company, as it raises fresh capital for business growth. Finally, the investors, as regular investors, can buy shares early, potentially earning profits if the company grows and its share price rises. Well, having learned all this, should you invest in IPOs? Before diving in, consider these points. Understand the business. Does the company have growth potential? 2. Purpose of the IPO. Is the money being raised for expansion or promoter exits? 3. Valuation. Compare with peers in the industry to ensure you're not overpaying. 4. Market sentiment. IPO success often depends on overall market enthusiasm. So back in the 2021 when Paytm IPO saw high expectations but underperformed because many investors felt it was overvalued. On the other hand, Adani Wilmar's IPO in 2022 gained traction due to its fair pricing and growth story. To sum it up, yes, IPOs can be an excellent way to participate in the growth journey of companies, but only if you research thoroughly. What's your favorite IPO story? Let us know in the comments. And hey, don't forget to subscribe to My FinHub, your friendly guide to simplifying finance and amplifying knowledge. See you in the next video.